So we've been underweight on India on a few concerns, on a few reasons. It's not just valuations; it's high valuations, higher than usual, coupled with fairly lackluster performance from companies. Over the last 1 to 2 years, and especially recently, you're seeing intense earnings cuts, much more than what you see for the rest of the region. But why an upgrade now? It's in the context of the tariff tensions and the trade tensions that are going on. We felt it's better to look at markets which are kind of immune and defensive. So we basically defined defensive and and domestic exposures as preferred criteria in this context. Keep in mind, again, this is relative.
Yes.
China as a market actually ticks all of those boxes as well. So China remains an overweight for us, but India, on a relative basis compared to other markets, which are tech oriented, or Korea, Taiwan, etc., it made a lot more sense. In saying that the downside for India is probably contained in this kind of a situation. Now, the GDP forecast cuts that you mentioned, that's going through for almost all markets, given the source of those worries, is basically the tariff. So it's kind of common for all markets. So yeah, I mean, we are looking at it from a relative perspective.
Understood. How compelling is valuation, Sunil, now after the drawdown from the highs? And have we almost returned to a buy India, sell China, risk-reward narrative within EM broadly, given the sheer tariff arbitrage with India at 26% versus China's, 125, 145%?
Yes, that's the most important question that we are also facing, when in our conversations with investors. Let's look at some facts. Let's start with valuations. In our numbers, India is still about 20% above its 10-year average valuations PE multiples, whereas China is 20% below, right? And the rest of EM is pretty much on par with their long-term history. So India is still at a premium, in spite of the drawdown that you mentioned since September last year. In terms of tariffs, again, when we look at the composition of the indices, both China and India, the MSCI indices, the stocks in the index are generally domestic facing. They're not exporters. So when we look at, MSCI China, about 85% of top line comes from within China. And the same number for India is about 75, 77%. So these are both markets and bunch of stocks which are fairly domestic and inward forcing, not so much exposed to global trade flows. So then that it all boils down to the difference between 26 and 145. How long will 145 last? We already see that it's some carve-outs have happened for 1/3 of the exports to the US,
Yes.
and which government has the better ability to give a stimulus given their own balance sheet and fiscal constraints in case there is a slowdown.
Yes.
So combining all those factors together, we still feel the risk reward is far better in China than in India.